When the world's most successful investor starts selling billions in stock and sitting on record cash, the world pays attention. In this week's PyUncut Market Breakdown, we dive into why Warren Buffett, the Oracle of Omaha, is suddenly more cautious than ever, and what that might be signaling about the future of the economy. Buffett's big moves, selling the winners. Warren Buffett has just sold over $4 billion of Apple shares, cut his Bank of America stake by 41%, liquidated T-Mobile, and halved his Charter Communications position. That's not trimming, that's a strategic retreat. This marks the 11th straight quarter that Berkshire Hathaway has been a net seller of stocks. The last time Buffett was buying was all the way back in Q3 2022. Now, his legendary conglomerate sits on an astonishing $344 billion cash pile, the largest in the company's history and more than Apple, Microsoft, and Nvidia combined. For a man whose entire life revolves around investing capital, this isn't random, it's deliberate. And when Buffett hoards cash, investors start asking, what does he know that we don't? History repeats. Buffett's timing is never coincidence. Buffett might insist that he never makes investment decisions based on economic predictions, but his track record tells a different story. He built up cash in 2007, right before the global financial crisis hit, when U.S. stocks plunged 60%. Then he bought the dip in 2009, 2010, scooping up bargains while the world was panicking. Fast forward to late 2021, Buffett again held record cash levels just before the market topped and entered a 20% decline in 2022. Each time he redeployed his reserves at the perfect moment. Is it luck, instinct, or data? Maybe all three, but the pattern is unmistakable. When Buffett goes defensive, something big usually follows. So why all this caution now? Analysts point to three key reasons driving Buffett's record cash strategy. The market is overvalued, and Buffett's own indicator proves it. Buffett's favorite valuation metric, known as the Buffett Indicator, compares the total U.S. stock market capitalization to GDP. Right now, it's sitting above 200%, meaning the market is worth twice the size of the entire American economy. That's the highest level since 1947. Much of this excess comes from the AI-driven rally pushing a handful of tech giants, Apple, Microsoft, Nvidia, to near-mythic valuations. Even OpenAI CEO Sam Altman has called the current AI market a bubble. For a value investor like Buffett, that spells danger. His mantra has always been, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But when nothing looks fairly priced, the only smart move is to wait. Historically, periods of extreme valuation like this have almost always ended in market corrections, sometimes mild, sometimes brutal. Concentration risk, the fragile foundation of the S&P 500. The top 10 companies now make up more than 30% of the S&P 500's total market cap. That's the most concentrated leadership in U.S. stock market history. It means the entire index, and by extension, most retirement portfolios are heavily dependent on a few companies' performance. If one or two stumble, the ripple effect could be enormous. This narrow market breadth is exactly the kind of structural fragility that Buffett hates. He prefers diversification built on fundamentals, not hype. The debt time bomb, America's growing fiscal problem. Buffett's second major concern isn't corporate at all, it's macroeconomic. The U.S. national debt now exceeds GDP, crossing into a zone where history shows inflation and currency risk can spiral out of control. At Berkshire's latest shareholder meeting, Buffett bluntly said, runaway fiscal policy is what scares me most about the U.S. economy. His worry is simple. When governments borrow more than they can repay, they start printing money, and that devalues the currency. For everyday Americans, that means savings lose purchasing power, wages lag behind inflation, and long-term investors face diminished real returns. Buffett's response? Cash, caution, and real assets. So how does the Oracle of Omaha protect Berkshire from all this uncertainty? He's doing what he always does, buying durable businesses that can thrive in tough times. Recently, he's added stakes in DR Horton, home building, Lamar advertising, billboards, NVR, industrial and housing. These companies have three traits Buffett prizes in a stormy economy: tangible assets, land, property, factories, that hold value even when currency weakens; strong cash flow, providing consistent returns even during recessions; and attractive valuations, trading well below overheated market multiples. In short, Buffett is positioning for resilience, not momentum. The power of patience. Buffett's philosophy hasn't changed in 7 decades. He still lives by one core belief. The stock market is a device for transferring money from the impatient to the patient. When opportunities dry up, he simply waits, allowing cash to build until prices make sense again. That patience is why Berkshire has compounded wealth for over half a century while others chased fads. Right now, patience looks like the smartest play in town. What the numbers say. Let's break down the data that validates Buffett's current caution. Metric. Current level, historical average, Buffett's take. Buffett Indicator. Market cap divided by GDP, 200%. Historical average, 85 to 100%. Buffett's take, overvalued, expect correction. U.S. national debt divided by GDP, 102% plus. Historical average, 65%. Buffett's take, fiscal risk, inflation ahead. Cash on Berkshire's balance sheet, $344 billion. 10-year average, $150 billion. Record high liquidity. Top 10 S&P 500 companies weight, 32%. Historical average, 20%. Buffett's take, concentration danger. That's not the setup for a crash necessarily, but it's a setup where risk-adjusted returns look unattractive. The counter-argument. Maybe it's not all doom. Not everyone agrees with Buffett's gloom. The Federal Reserve has managed to tame inflation so far, holding it near 2.7%, and most major investment banks expect interest rate cuts by 2026, possibly bringing the federal funds rate down to 3 to 3.25%. If inflation keeps cooling and corporate earnings remain robust, Buffett's caution might look overly conservative in hindsight. But remember, his goal isn't to beat the market every quarter, it's to avoid big mistakes over decades. The real lesson, discipline over drama. Buffett's current stance isn't about predicting a crash, it's about risk management, about knowing when not to play. He has always said, the first rule of investing is don't lose money. The second rule is don't forget rule number 1. Sitting on cash may not be glamorous, but it's powerful. Because when panic hits, those with cash, not debt, get to buy the future at a discount. That's exactly what Buffett did in 2009, 2010, and 2020. And history suggests he'll do it again. Takeaways for everyday investors. So what can you learn from Buffett's caution right now? 1. Don't chase hype. AI, tech, and growth stocks look tempting, but stretched valuations can snap back fast. 2. Build cash reserves. Having liquidity means you can act when others freeze. 3. Focus on value, not noise. Look for companies with real assets, steady profits, and low debt. 4. Think long-term. Markets move in cycles. Buffett isn't scared, he's waiting. Final word. Buffett's record cash pile isn't a prophecy of doom. It's a reminder of discipline. He's not betting against America, he's betting on patience. As markets soar on AI optimism and cheap liquidity, Buffett is quietly preparing for the day when fundamentals matter again. When that day comes, Berkshire Hathaway's billions will be ready to deploy, just as they have in every crisis before. For investors, the takeaway is timeless. Be fearful when others are greedy, and greedy only when others are fearful. And right now, the Oracle of Omaha looks just a bit fearful.